This is the WorldCom fraud analysis presentation presented by Chris Clark, Taylor Adams, and Sam Bragg. The WorldCom chain of command helped contribute to the WorldCom fraud because the two executives who were the main perpetrators in carrying out the fraud, Bernard Ebbers, CEO, and Scott Sullivan, the CFO, were directly above the internal audit director, Cynthia Cooper, who began investigations into the fraud after becoming suspicious. Underneath her, she had Gene Morse, who was a major helper for her in their internal audit and discovering the fraud, and then she also had the rest of her internal audit team. It was difficult for her to investigate because she reported her findings in the chain of command to Scott Sullivan, who was constantly steering her away from any facts that could have led to the fraud that he was helping to perpetrate. So she eventually had to go around the chain of command in order to report her findings. In 1995, LDDS Communication Company changed its name to WorldCom. WorldCom began to grow quickly through acquisitions of other telecommunications companies. However, by 1999 and 2000, as the market began to slow, WorldCom began to commit fraud in order to boost its profits. At this time, that mainly included accrual releases in order to inflate profitability. In the early 2000s, fraud began to grow more rampant at WorldCom. They began to capitalize expenses, classifying them as prepaid capacity for communications lines that weren't being used. These costs should have been expensed rather than capitalized, but the capitalization allowed WorldCom to boost its perceived profitability. In August 2001, Cynthia Cooper, Director of Internal Audit, began to uncover the fraud that was happening at WorldCom, and eventually, a year later, reported her findings to the SEC for independent investigation. In 2002, trials began to be held for the fraudulent employees at WorldCom. And by 2004, Bernard Ebbers, CEO of WorldCom, as well as other guilty employees, were indicted by the U.S. Department of Justice.
Facts and major players. In 2002, WorldCom Group filed for bankruptcy. Executives at WorldCom had been ordering and committing fraud in order to mislead stakeholders about the poor condition of the company. The fraud was discovered when WorldCom's internal auditors became suspicious and investigated and ultimately discovered the fraud. The major players are Bernard Ebbers, CEO, Scott Sullivan, CFO, David Myers, Controller, Buddy Yates, General Accounting, Betty Benson, Management Reporting, Cynthia Cooper, Internal Audit, Gene Morris, Internal Audit. Earnings Management. The AICPA says earnings management occurs when 1. Firm management has the opportunity to make accounting decisions that change reported income, and 2. Exploits those opportunities. Sometimes earnings management is just good business and can be used to make financial statements more accurate. For example, choice of depreciation method or choice of FIFO or LIFO inventory management. WorldCom crossed the line into fraudulent reporting by accrual releases and by capitalization of expenses. They use strategic accounting treatment to intentionally mislead stakeholders.
There were several motivators behind the fraud in the WorldCom case. First of all, there was a race for market share. Once A&T was dismembered and the 1996 Telecommunications Act was signed, many telecommunication companies raced to acquire their fair share of the market. With this attempt to acquire as many shares of the market as possible, companies were reliant on their company's assets to use as collateral for the purchase of the smaller companies. WorldCom leaned on its high-valued stock as a means of acquiring small companies. This fraudulent activity was partially motivated by the desire to build a sufficient backing to acquire other companies and not have to pay margins. Also, expectations for the Board of Trustees. At one point, the Board of Directors were expecting cuts in capital expenditures without sufficient knowledge of how the cuts would be made and what effects it would have on other aspects of the company. Information was easily manufactured to pacify the Board of Directors at their quarterly board meetings. With this obstacle out of the way, Sullivan was free to run the company as he deemed necessary. Last but not least, evading internal and external auditors. Once the fraudulent activity had begun, it was quite hard to stop. The amounts that were fraudulently removed in previous quarters were being covered up by larger portions in subsequent quarters, in an effort to evade auditors. Although this may not have been an initial motivating factor of the fraud, it was definitely a motivator to continue the fraud.
There are several pressures that WorldCom management faced in their decision to commit fraud. The economy at the time was slow, especially among telecommunications companies. The majority of other telecommunications companies were reporting losses, and WorldCom felt the need to stay on top and show consistent growth, even though the industry was slowing. Another influence was shareholder perception and Wall Street forecasts. A major influence in keeping stock prices high was analyst ratings, and the way for WorldCom to get a good analyst rating was to maintain their revenue to expense ratio. This was a major influence in boosting revenues and cutting expenses because it kept their stock price high and helped them meet Wall Street forecasts and also keep shareholders happy. Another influence was fear that WorldCom would have to start taking losses and become an irrelevant telecommunications company and fall into the same trough that the other telecommunications companies were in at the time. This fear is what influenced them to choose fraud over ethical practices.
The corporate culture of WorldCom was extremely tense. It was forceful, fragmented, negative, and full of fear. Forceful because senior management ran the company with an iron fist. They indicated that they were the only ones with the right answer. Managers were known for offering threats and personal criticism to subordinates. An example of this was Gene Morse's comment, "If you show those damn numbers to the effing auditors, I'll throw you out the window." Instead of running the company with motivation and inspiration, senior managers ran it out of fear. Fragmented because WorldCom was built on the acquisition of smaller companies. This is a strong competitive strategy as long as the company is able to draw the smaller companies into their current culture. This was not the case for WorldCom. A former manager added, each department had its own rules and management style. Nobody was on the same page. In fact, there were no written policies in 1995. There are several ways that we can use the fraud triangle in this case. The fraud triangle identifies three elements that are present when fraudulent activity abounds. Pressure. Managers found themselves under constant pressure to meet senior management's expectations, so that the company could continue to meet stock analysts' expectations. Furthermore, the subordinate employees felt it necessary to comply to managers' requests, or they would be met with personal criticism and threats. Opportunities. Numerous opportunities were present in WorldCom. It is important to note that the Board of Trustees was compiled of knowledgeable people, but not necessarily knowledgeable about the matters of the industry. Furthermore, the Board of Directors did not make an effort to request the necessary information for them to do their due diligence. This left Sullivan and Evers to run the company as they see fit, and also to present and limit whatever information they felt was necessary to continue the perceived success of the company. Although different people had different responsibilities in different departments, there was no true segregation of duties. This is due to the ability of senior management to force subordinates to do things their way regardless of its lack of compliance with generally accepted accounting principles. Rationalization. For subordinate employees, the rationalization is quite understandable and evident. Employees wanted to keep their jobs. They knew that the odds of them being able to go out into the market and acquire jobs of similar title and pay would be next to impossible. Furthermore, their reported success had a direct causation with their pay. As with other companies, employees rarely feel as if they are compensated to the rate at which they should be, and feel as if the additional income that is created by the fraudulent reporting is just their way of getting what is already theirs. It is our belief that senior management also convinced itself that this was the only way that it had to be done, and that there was no other way to get it done. As many other fraud perpetrators believed, the perpetrators in the WorldCom case believed that the fraudulent activity would only take place for a short amount of time, and then they would rectify everything before anyone got hurt. As evidence of this, in Mr. Sullivan's testimony, he says that I thought we were going to get through it in a short period of time. I knew it was wrong, and I knew it was against the law, but I thought we would make it through.
What is prepared capacity? Prepared capacity was not defined well by the employees when asked. This is because management kept this information from the employees so that they did not know exactly what was going on. WorldCom used this term to reassign the expense of unused or underused fiber lines as a capital asset that was depreciating. This heavily understated the company's expenses, simultaneously increasing perceived profitability. How did the fraud before detection improve the financial statement of WorldCom? If you look here at the 10K from 2001, you will see that the reported line costs of expenses were $14 billion, but their actual line costs were $17 billion. This is a $3 billion change that they then moved to their income, which you can see to the right of that, which was increased by $3 billion this year. They had an actual income of a loss of $622 million, but reported a income of $2.3 billion. This is showing that they were using this to inflate their company's profitability ratios so that their stock would be higher and that they would get better analyzation from different clients so that they can produce a higher stock margin and bring in better stock.
There were several stakeholders affected by the fraud in the WorldCom case. First off, there was the WorldCom senior management. Senior managers were sentenced to prison for their roles in the fraud, ordered to pay restitution, and most likely will never find another job in a related field. Next, WorldCom employees. Employees lost their jobs and stock options that they were given as employee incentives, which were left relatively worthless. There were competitors in the market. With WorldCom absent from the market share, a subsequent fight for their shares commenced, in an effort for another company to establish itself as the dominant company of the industry. Clients. Many clients were left in jeopardy of losing their telecommunication services due to the closing of WorldCom, which included air traffic control for the Federal Aviation Association, network management for the Department of Defense, and long-distance services for both houses of Congress and the General Accounting Office. Last but not least, auditors. Arthur Anderson was ordered to dismantle shortly after the discovery of this fraudulent activity and their lack of due diligence in the discovery.
There were several reasons the WorldCom fraud was not discovered earlier than it was. Some of these include senior management desires. WorldCom senior managers were the main perpetrators in the fraud, and because of their levels of power, they were able to manipulate numbers and employees to carry out the fraud that they were trying to use. Another was job independence. WorldCom's lower level employees were so controlled by the pressures of management that they chose to just obey whatever they were told to do and give in to management's threats rather than remain independent and do what they knew was right. Another issue was auditors' continued desire to keep one of their most profitable clients. Arthur Anderson saw WorldCom as a money-making entity rather than as a client that they needed to monitor carefully and in order to do their job and ensure the financial statements were reliable. Another issue is lack of involvement by the board and audit committee. Part of this issue came because they were receiving false information from management. However, it was true that they did not spend enough time on WorldCom, as it was reported some of them only spent 3 to 5 hours a year meeting with that big of a client and that high of a risk of fraud. There needed to be more involvement by the board.
Internal audit. The WorldCom internal audit team grew suspicious of excessive capital expenditures that could not be justified. After being turned away by the CFO and the controller and told to leave the matter alone, the team decided to conduct their own financial audit. In doing so, they discovered multiple frauds being carried out by management. Internal audit team roles. Cynthia Cooper was the head of WorldCom's audit team, led the effort to investigate suspicious accounting despite discouragement by management. Gene Morris transferred from management accounting job after the threat from manager. Did computer-based work in the investigation with Cynthia Cooper. Glenn Smith, manager on Cynthia Cooper's internal audit team, helped investigate fraud and confronted Betty Vinson about fraudulent entries. Did Sullivan intimidate Cooper? Yes. Sullivan demanded delays and reductions in scope of audit. He also forced information requests to flow through him so he had complete control. He also confronted Cooper after she presented findings to the WorldCom Audit Committee. Once doing that, he then began to become harsher on her and more intimidating. Cooper recalled Sullivan screaming at her in a way that she had never been talked to before by anyone.
Cynthia Cooper faced several ethical issues as an internal auditor at WorldCom. Some of the issues she faced when she started to grow suspicious of fraud were, was it worth losing her job if she exposed this fraud? How would she go against the direct instructions of her managers to find out more information about the fraud? And should she conduct secret audit operations against her manager's wishes to expose the fraud? When she grew suspicious, she had to deal with these ethical issues and determine, was her personal work situation more important than her obligation to expose the fraud and tell stakeholders what was actually happening in the company. Her ethical obligations as an internal auditor were to report fraud if discovered, to investigate any suspected fraud, to carry out proper procedures to obtain evidence of the fraud, and to resist threats from management. Cynthia Cooper faced backlash to all of these obligations as she conducted her own audit procedures. She had to know who to report the fraud to once she gathered enough evidence. She had to treat the evidence in the correct way so that once the fraud was discovered, it could be used against WorldCom to prove what they had done. And in doing all of this, she had to deal with her direct management constantly threatening her and pushing her away from what she knew was right. Cynthia Cooper was obligated to carry out this task to mainly the WorldCom stakeholders. As an internal auditor, stakeholders rely on her to know that the internal operations of the company are functioning appropriately, and to know that there's someone on the inside who has that information that is watching out for them and making sure the information they're receiving is not fraudulent. So, like I said, she made the correct choice to keep investigating the fraud and expose it despite all the backlash she was receiving from her managers. Once she had enough evidence, she reported her findings to the SEC, who were able to carry out an independent investigation of what had been going on at WorldCom. She made this decision because she believed that her obligations to stakeholders and financial statement users were more important than her own job security and more important than what her managers were telling her to do. Betty Vinton was a accountant for WorldCom, and although she didn't have the same malicious intent that her managers had in intentionally misleading WorldCom financial statement users, she was still complicit in the fraud. She was threatened at first and forced to make entries that she knew were fraudulent, and she thought it would be just a one-time thing, but it ended up continuing. This is important because even if it seems like it's small at the beginning, fraud is still fraud, and in a big company especially, it will typically continue to escalate. In her case, she ended up playing a role in over hundreds of millions of dollars worth of transactions. So her role in making those entries ended up having a much larger impact than she thought it would. While she might have not been as big a villain as Ebers or Sullivan, some of her managers, she was still guilty of fraud in this case. The external auditors were to blame in the WorldCom scandal. They became much more concerned about making money off of WorldCom as a client than they did about reporting correct financial statement information. They even knew that WorldCom was a high-risk client, especially because of the market of the telecommunications industry, and WorldCom continued to make above average profits. So Arthur Andersen knew something was wrong, and although they classified them as high risk, they never audited them in that way. So they just kind of ignored what they knew was right in front of them. They did try and cover up their errors, though, by claiming that WorldCom had provided them with false information, which was true. And because of that, they were not able to detect what was really going on. However, had they followed their initial suspicions and actually audited WorldCom as a high-risk client, those further tests would have led them to the fraud. And this is a quote by Arthur Andersen saying why they were unable to discover the fraud. Another interesting take on the WorldCom scandal was the impact it had on WorldCom's competitors. So not only were direct WorldCom financial statement users affected negatively, competitors also were, because the industry was so down as a whole at the time. WorldCom's success through that period caused competitors to have even worse earnings in those years. This made them make decisions based off of that to try and keep up with WorldCom, like laying off employees and cutting programs, and these affected thousands of people, and it was all for nothing because WorldCom was also going through the same struggles. It was just perceived success that was causing them to make big decisions that affected a lot of people. There are a lot of lessons we can learn from this fraud, but some of the main ones are the importance of having internal controls, informal restructuring of organizational charts, as auditors always doing due diligence and always trying, as HR, trying to hire people like Cynthia Cooper who are willing to do the right thing. Another lesson is companies that have a cult-like following of their executives and managers, auditors and investors should be wary of those. In a case like WorldCom, Bernard Ebbers, the CEO, and Scott Sullivan, the CFO, had too strong of an influence on their employees, and their employees followed them so religiously that they just believed whatever they said was correct and that would all work out in the end. And this led for the opportunity to carry out fraud. Another lesson is that fraud is never worth it, even if the company isn't doing well in a certain period, and it may seem like you can carry out a few small things just to make the company look better in those years. It always escalates, and there's always more. And once it's found out, it's never worth the short-term benefit. In this case, it led to the fall of the entire WorldCom company and ultimately contributed some to the fall of Arthur Andersen.